In order to be able to really make informed financial decisions on whether a project is good or not, and if project A is better than project B, is we must look at our cost of equity. And if you remember in the last module, when we were talking about capital structure, we talked about the cost of equity versus the cost of debt. Well, here is a formula for calculating our cost of equity. And please don't get intimidated by the formula. All formulas look a little scary when we first look at them, but once we break them down into their base components, they become easier to understand. And this is the standard model for calculating for every organization what's called our cost of equity. That really refers to what do our shareholders expect in an annual return. If an investor buys shares in our company, what return do they expect each year on their money, on the capital they invest? Basic approach is to take what's called the Capital Asset Pricing Model, or CAPM. The formula reads capital R subscript F plus the beta symbol times a quantity, that is capital R subscript M minus capital R subscript F. So what does this mean? Well, R, the capital R, refers to required rate of return. The subscript F refers to the risk-free rate. In other words, the first element in the formula, and in Excel and in mathematics we call that an argument, the first argument or the first element in the formula is what is the risk-free rate of return? In today's market, for our organization, if we had money in the bank, in a certificate of deposit, in a savings account, in a government security, each of which present virtually no risk to us of losing our principal, what rate could we get? Well, this changes constantly. In fact, it'll probably change, as this formula will, every time you calculate it. And the investing world understands that. So let's presume for our argument's sake, that's 2%. Okay, next component, the beta coefficient. The beta coefficient is a measure of volatility. How much do our shares go up and down in the marketplace compared to the rest of the market? All right, I'll give you some good news here. We don't have to calculate the beta coefficient. The beta coefficient is published for virtually all listed companies in a variety of websites and every investment house around. So if you're looking at Apple or Dell or IBM or Saudi Aramco, you can find their beta coefficient on the net, Yahoo Money, Google Money, or you can call up any major brokerage house and they will have that. If you are strong in your mathematical skills and want to actually calculate this, there is a regression formula to calculate this. But let's make it simple. It measures how much our shares move up and down in the marketplace over time compared to the market in general. Beta, let's use 1 as neutral. That means our shares move up and down generally as the marketplace moves up and down. If the beta coefficient is higher than 1, that means there's more volatility in our shares. Our shares move up faster and more than the market when it's going strong, and move down faster and more than the market when it's doing poorly. The higher the beta, the higher the volatility. The higher the volatility, the higher the risk. That's why the beta is the multiplier there you see in the formula. Now, it's very important to recognize that betas can only be calculated for listed or public companies. If the organization we're looking at is not public, there is no beta coefficient. If there's no beta coefficient, there's no way to calculate the capital asset pricing model. So what do? Well, reality is we have to look at other organizations similar to ours, as close as possible, that are listed or public, and calculate their beta, and therefore use that in the formula. Unfortunately, that's as good as we can do. And the real reason is if we're not a listed company, there is no marketplace. Our shares are not freely traded. There's no way to know what the actual return is because there's no basis of comparison. That's the only limit of the equity calculation. So if we're talking about a listed or a public company, then again, the beta measures the volatility. That's why it's a multiplier there. The next quantity, R sub M, is what is the rate of return that the typical investor wants? What's the rate of return on the average equity investment? So let's say that's 13%. Well, you'll notice within those parentheses, we're subtracting the risk-free rate that we already have on the front end. What was the risk-free rate? That was 2%. So if the market required rate of return is 13, the risk-free rate is 2, therefore the net of this is 11. So if our risk-free rate is 2, that's the first element in the formula. If the beta coefficient, let's say, is 1.5, if the R sub M minus R sub F gives us 11, we have 1.5 times 11. That'll give us about 16.5%, plus our risk-free rate of 2 equals 18.5% is our cost of equity. That's not good or bad. It is a mathematical reality. What does that tell us? It tells us that our shareholders in the current calculation, in the current period, are looking for an 18.5% annual return on their invested money. And if that seems high to you, then you can sit back and say, why? Well, there's two real reasons. One is, look at our beta. Our beta is 1.5. It's 150 times, or 150%, 1.5 times more volatile than the marketplace. That means that the market looks at our shares as being 50% riskier than the average shares. What can we do to change that? The bad news is today, nothing. The good news is over time, if we manage our organization appropriately and meet more of our targets, that will gradually decline and get closer to 1. In the short term, it means we need to find projects that pay out on an annual basis and higher return than perhaps we want. So we're actually taking more risk to meet the shareholders' expectation, which is high because they think there's risk in our organization. They're tied hand in hand. On the debt side, much easier, much more straightforward to calculate. Our long-term borrowed money is always made up, first of all, of bank loans. Every organization borrows from banks. Now, most of these loans are going to be 5 years or less. They are to finance our short to medium-term capital assets. We may also have bonds. Now, these are not corporate bonds. These are not government bonds, of course. They are corporate bonds. Most of the countries in the world allow organizations that meet specific criteria to sell corporate bonds, long-term, unsecured corporate borrowing. Why would we want to sell corporate bonds? Well, from our standpoint, there are some very good reasons. From the investor's standpoint, there's some very good reasons to buy them. From our standpoint, a corporate bond has a fixed rate of return called the coupon rate. We'll be able to predict our cost of these bonds, which would be the same every year, over the entire life of the bond. So planning cash flow becomes easier. That's number one, fixed rate of return. Number two, they are for a longer period of time than bank debt. Remember, bank debt is normally 5 years or shorter in term. Well, for a lot of our projects that run 10, 15, 20 years, we would like a longer form of repayment. So bonds are generally sold to the public for 10, 20, or 30-year increments. So very long-term source of finance at a fixed return. Number three, bonds generally cost us a little less than bank debt. So the cost is lower. But number four, and one of the biggest benefits of corporate bonds, is there's no principal repayment until the end. So if we sell 20-year bonds at 6% and the market buys 100% of those bonds, that means that we have an obligation to pay the bondholders a 6% return each year in cash, which we do, but none of the principal. So if we sell 100 million in bonds for 20 years, we can use that 100 million in the organization until the 20th year when it must be repaid. Well, are we going to have 20 million or 100 million or whatever the number is sitting around in 20 years? Probably not. We have several options. We could each year over the life of the bond put a certain amount of money away, 1/20th or 5%, called a sinking fund. Or more likely, if we are as strong in the future as we are today, we would sell a new bond to the public and use the proceeds to pay off the old bond. It's a win-win. New investors have an opportunity to buy debt in our organization. The old investors get paid exactly what they were promised. We have no out-of-pocket expense other than the annual coupon. So those are some of the advantages of financing our long-term debt via bonds. Well, if it's that good, why doesn't everybody use bonds? Good question. In most countries, in order to sell bonds to the public, you must be a relatively large, relatively strong organization. And in many cases, you have to be a listed or a public company. And the reason for this is fairly simple. If you're selling financial instruments to the public where you're not going to repay the principal for 10 or 20 or 30 years, all potential investors must be able to get a large amount of financial information on you, and it must be of very high quality. Well, remember when we were talking about the various levels of quality on financial statements? To sell bonds, we must generally, again, this is in most countries, have produced a minimum of 3 consecutive years of audited financial statements with no exceptions, no problems in the financials. So listed or public companies can and frequently do sell corporate bonds. Smaller private companies rarely have the ability or the financial need to sell bonds. Because, by the way, to sell a bond, the process, all of the accounting and legal expenses to prepare and sell the bonds cost hundreds of thousands, if not $1 million or $2 million. So rarely will a small private company be able to justify, from a financial extent, creating and selling bonds. So they're usually in the 10, 25, $50 million range. Most private companies don't need that amount of capital. So it's a very good debt instrument in the right circumstances. The third form of debt that's extremely common, and we talked about capital leases in the previous module, are capital leases. Capital leases, if you remember, are long-term rental obligations. They are almost the same as buying an asset, but not quite from a legal and a tax standpoint. But a capital lease is signing a long-term contract with a lessor. They're the owner of the asset. We, as the lessee, have exclusive use of that asset in exchange for committing to and making a very long series of payments. So capital leases are a way to finance our long-term assets, our projects. Bonds are, and loans are. The combination of the three is how most organizations have all of their long-term debt. So what's our cost of debt? We look at what proportion of our debt is loans at what rate. What proportion of our debt capital is bonds at what annual coupon rate? What proportion of our long-term debt are capital leases at the imputed or estimated rate? Here's an Excel spreadsheet that we provided you as a quick way to look at our weighted average cost of capital, looking at how much of the capital in our organization is equity, how much is debt. Let me walk you through this from left to right. Remember, the yellow cells are inputs, the green cells are the outputs. E represents the equity investment in the company. That's the number of shares in the marketplace times the per share value today. Yes, it will change every time we calculate this because the market price changes. So what proportion of our capital is equity? What proportion is debt? V is the total value of our capital. So if we have 75 million in equity and 25 million in debt, we'll have basically a 75-25 equity to debt proportion. And that's what we have in our very first line. 78.43% of all of our capital is equity. The difference, 21.57, is debt. Those add up to 100%, of course. R subscript E, that's the required rate of return on equity, or what we've calculated using the capital asset pricing model. In this case, it's 15.35%, same as 0.1535. That's very close to what we had calculated earlier. So if 78.43% of our capital is equity, the cost of equity to us is about 15.35%. That's your first quantity on the left. Then the percentage of our capital provided by debt, oh, I see we have an error there, we'll fix that, is 21.5%, and the cost of debt is 10%, that's your R sub D, and then the T sub C, the tax rate, is 45%. Why is that element in here when we're calculating our cost of capital, our WACC, our weighted average cost of capital? The reason is in most countries, if you remember our previous discussion, the cash cost of debt is interest. Interest is a tax-deductible expense. So going back to our discussion in modules 1 and 2 of our income statement, we have our revenue minus our cost of goods gives us gross profit, minus operating expenses gives us our operating profit before interest and tax, EBIT. This is the interest expense. The interest expense is a tax-deductible expense. Therefore, we get to reduce our income by that amount before we calculate the tax due. So what this formula is showing us is we look at our cost of debt, in this case, 10%. We get to multiply that times 1 minus our tax rate to show the benefit of the interest. In other words, what's the net cost? So in our very first line, 10% is our cost of debt, but the tax rate is 45%. Well, 1 minus 0.45 is 0.55. The net cost of our debt is only 5.5%. So 21.57% of our capital is debt at 10% before tax, at 5.5% after tax. That becomes the second element. So 75%, 78.43 to be precise, of our capital costs us 15.35. 21.57% costs us 5.5. You multiply those together, and the weighted average cost of capital under this amount of leverage is 13.23%. Now, if we were to change the proportions of debt to equity, go to the second line, 50% equity, 50% debt, same cost of equity, same cost of debt, lowers the weighted average cost dramatically. You can see as we change our leverage, it has an impact on our cost of capital. Going back to the previous module, the higher the debt to equity proportion, go to the bottom half of the slide. The higher the cost, the higher the amount of debt, the higher the proportion of debt to equity, the lower the cost of capital. The bottom half of the spreadsheet really makes it very clear. To make things simple, we have no taxes at all. Equity costs us 15%, debt costs us 8%. If we're 95% equity, 5% debt, WACC is 14.65. At 60% equity, 40% debt, it drops all the way to 12.2. At 10% equity, 90% debt, it drops all the way to 8.7. Now that would mean that we have a 9-to-1 debt to equity proportion. Good news is we can figure that out in Excel. The bad news is I've never seen that in any organization in the world. Lenders don't ever provide that much capital, but mathematically it does show us how our weighted average cost of capital can change dramatically as our proportions of debt to equity change.